The $50,000 experiment, 4 paths, 30 years, and one brutal math lesson, 4 people. The exact same starting stake, $50,000. The exact same rules, lock it away, let it grow for 30 years, and don't touch a single penny. What happens next reads like a masterclass in how human psychology collides with the cold, unforgiving laws of compound interest. The first buys the ETF her coworker won't stop hyping in the break room. The second buys the mutual fund her financial advisor set up years ago, the exact same one her parents held since she was a kid. The third buys an index fund. It was the cheapest option on her brokerage app, took 90 seconds to tap, and she didn't give it another thought. The fourth gets a late-night call. A friend of a friend can slip him into an exclusive fund most people never even hear about. The minimum buy-in is higher than his car, and there's a wait list just to apply. He says yes on the spot, convinced that anything this fiercely guarded has to be a gold mine. 30 years vanish. 3 of those outcomes land right where your intuition tells you they should, but one doesn't. And I promise you, it is not the one you are picturing right now. I know how wild that sounds. Let me earn every single syllable of it. To understand how this story ends, we have to look past the marketing gloss and put real names to the first 3 characters. Vanessa bought the ETF. An exchange-traded fund is simply a massive basket of investments, hundreds of top-tier companies bundled together that trades on the stock market just like a single share of stock. She can buy or sell it any second the market's open, at whatever price it's flashing. Jasmine bought the mutual fund. A mutual fund is also a basket of investments, but it doesn't trade throughout the day. You drop your order in, and at the market's close, everyone who bought or sold that day gets the exact same closing price. It is older, slower technology built for a world before phones could execute real-time trades in your pocket. Marcus bought the index fund. This is where the financial language gets slippery, because an index fund isn't actually a competing category to the first 2. It's a strategy. An index fund doesn't try to beat the market, it tries to copy it, holding the exact same companies in the exact same proportions as a benchmark like the S&P 500. Here's the twist most investors miss. An index fund can be packaged as an ETF or as a mutual fund. Marcus happened to buy his as a plain, no-frills mutual fund. Already the question of which type is best is a trap. People blend 2 entirely different questions into one. How do you trade it? ETF versus mutual fund versus what is it trying to do? Index versus actively managed. And there is a quieter structural difference under the hood. ETFs like Vanessa's allow large institutional players to swap shares directly for underlying baskets of stocks when cashing out, keeping things remarkably tax efficient. Mutual funds like Jasmine's don't have that escape hatch. When a wave of investors stampede for their money at once, the fund is forced to sell holdings on the open market, frequently triggering a painful taxable event for everyone still holding the fund, even if they didn't sell a single share. When you look at what Vanessa, Jasmine, and Marcus are paying every year just to keep their money parked, 2 of them are virtually identical, while one is playing a completely different game. Marcus's fund charges 4/100ths of 1% a year. Vanessa's charges 3/100ths of 1%. That gap is so microscopic it barely registers. On a $10,000 investment, the difference is literally a single dollar a year. Jasmine's fund tells a different story. Hers is actively managed, meaning there is a professional stock picker behind the curtain trying to outsmart the market. That expertise isn't cheap. The industry average for a fund like hers runs 64/100ths of 1% a year, more than 15 times what Marcus and Vanessa are paying. 15 times a tiny number is still a small number, right? On its own, it looks survivable. Keep that number in your back pocket. It is about to matter more than your sanity can comfortably handle. Now let's look at Jake. What Jake bought is a hedge fund. Most people, Jake included, couldn't tell you what a hedge fund actually does beyond the intoxicating vibe of exclusivity and wealth. Here is the unvarnished truth. A hedge fund is a private investment pool strictly gated off for the wealthy or institutional players. It is run by a manager with immense freedom. They can bet that prices will plummet, use dangerous amounts of borrowed leverage, and pour cash into corners of the market regular funds are legally locked out of. In exchange for that Wild West freedom, hedge funds charge a legendary structure originally coined back in 1949, 2 and 20. 2% of your total capital charged every single year, regardless of whether the fund makes money or loses your shirt, plus 20% of whatever profit the fund generates on top of that. While modern competition has nudged those averages down slightly closer to 1.5% and 17% of profits, it is still astronomical compared to what Vanessa, Jasmine, and Marcus are paying. Add in strict lockup periods where your cash is legally trapped for years with zero exit windows, and you begin to realize what exclusivity actually costs. To be fair to Jake, nobody goes into this blind. A waitlist and a massive minimum buy-in read as proof of elite quality to our human brains, and in many areas of life, scarcity does track quality. Furthermore, institutional giants, massive pension funds, university endowments, sovereign wealth funds allocate billions to hedge funds for three very real, very logical reasons. Uncorrelated returns when markets crash, downside protection from skilled managers, and access to exclusive strategies like distressed debt or private credit. For a multi-billion-dollar pension fund with obligations due every single year without exception, paying a heavy premium for ballast makes absolute sense. The question is whether those exact same rules apply to an individual investor with $50,000 and 30 years ahead of him. Jake is managing one account for one future goal. A pension fund's problems are not Jake's problems, even if the shiny brochure looks identical. Vanessa's ETF, growing at just under 10% after that feather-light 0.03% fee, turns $50,000 into $865,360. Marcus's index fund lands right behind her at $863,002, a microscopic $2,357 difference over 3 decades, driven entirely by one tiny basis point of cost. Jasmine's actively managed mutual fund, carrying that 0.64% fee that looked so harmless earlier, ends up at $732,361. That is $133,000 behind Vanessa. A fee that felt survivable in isolation just quietly cannibalized a luxury car's worth of wealth over 30 years. And then there is Jake. Once both hedge fund fees strip his returns down to an effective 6.25% annually, his $50,000 turns into $354,819. Let that sink in. Vanessa ends up with over $500,000 more than Jake, $510,000 $10,541 more, from the exact same starting point, the exact same market conditions, and the exact same 30 years. Jake's ending balance is barely a third of Vanessa's. That gap is more than 10 times his original starting investment. He didn't just pay a fee for a wait list and a velvet rope. Compounded across 3 decades, he effectively handed over 10 times his own starting capital for the privilege of exclusivity. And remember, none of these accounts added a single extra dollar after the initial check cleared. No monthly contributions, no reinvested raises. In real life, consistent investors keep feeding their accounts, making the gap between cheap passive investing and expensive active management grow into an absolute canyon. When you strip away the financial industry's smoke and mirrors, the great debate was never about index funds versus ETFs. Those are just different wrappers on the exact same underlying assets. The real dividing line, the razor edge that dictates whether you retire wealthy or work decades longer than you should, is passive versus active, cheap versus expensive. Nobody can predict what the stock market will do tomorrow morning, but fees are the single most predictable, hard-coded variable in all of finance. Every basis point you surrender today is a miniature anchor dragging down your future self. A higher price tag, a prestigious wait list, or a slick elite pitch does not automatically translate to a better outcome. Sometimes it does. Most of the time it's just an expensive tax on human vanity, disguised as sophistication. Before you put your hard-earned money anywhere, find the expense ratio. Demand to know what every layer of cost is actually buying you. Because if you don't take control of the math today, compounding will quietly spend the next 30 years making decisions you'll never get to undo.